So the Federal Reserve just cut interest rates. And yeah, that's got a lot of people scratching their heads because isn't inflation still kind of high? Let's dive into this. We're going to break down exactly why they made this move, what it signals about the economy, and what it all means for what comes next. Right? This is the central puzzle we're going to unpack here. The economy is sending some seriously mixed signals. You've got a cooling job market on one side, but still high prices on the other. So how in the world does the Fed navigate that? Okay, here's how we're going to tackle it in 5 parts. First, what did the Fed actually do? Then we'll get into the fundamental conflict they're trying to manage. We'll look at how they're balancing the risks, what they see coming down the pike for the economy, and finally, what they're telling us about their next move. All right, let's kick things off with the decision itself. What was the specific move they made at this last meeting? The committee in charge, the FOMC, decided to lower its main policy interest rate by 1/4 percentage point. You can think of this as the master lever they pull that influences borrowing costs for pretty much everything, from mortgages to car loans. So what does that mean in the real world? Well, the target for the federal funds rate, that's basically the interest rate banks charge each other for overnight loans, is now set in this new lower range. The whole point is to make borrowing just a little bit cheaper across the entire economy. Now, here's what's really important. This was not a one-off decision. It's actually the 3rd cut in a row after moves they made back in September and October. So in total, they've now lowered the rate by 3/4 percentage point in just a few months. That's a big deal. It signals a very clear and deliberate shift in their strategy. So why this series of cuts? To really get it, we have to go to the very core of the Federal Reserve's mission. It's something known as the dual mandate. Basically, Congress gave the Fed 2 main jobs. 1, keep people employed. 2, keep prices stable, which for them means inflation at about 2%. And here's the kicker. Right now, those 2 goals are pulling them in completely opposite directions. And this is where you can really see that tug of war in action. On one hand, you've got the job market. It's weakening. The Fed themselves say it's gradually cooling. Unemployment ticked up to 4.4%, and they see rising risks to jobs. But then, on the other hand, inflation is still at 2.8%, well above their 2% target. So what do? Do you cut rates to help out the job market, or do you hold them high to fight off inflation? That's the tough spot they're in. This brings us right to the heart of it all, how the Fed is trying to balance these massive competing risks. It really is like they're walking a monetary policy tightrope. And listen, the Fed chair himself basically said how tricky this is. He said, and I quote, "There is no risk-free path for policy. If you move too fast to support jobs, you risk letting inflation get out of control. But if you wait too long, that cooling labor market could turn into a full-blown recession. There's just no easy, perfectly safe option." So, in the end, they had to make a judgment call. They looked at both sides of their mandate, and they decided that right now, the growing risk of a weaker job market was the more urgent problem. The balance of risks, as the chair put it, has shifted, and that's why they pulled the trigger on a rate cut. Now, of course, these decisions aren't made in a vacuum. They're all based on what Fed officials think is going to happen next. So let's take a peek at their official economic forecast. These forecasts are all bundled into something called the Summary of Economic Projections, or SEP. Just think of it as a collection of predictions from each of the voting members of the committee. It really gives us a window into their collective thinking. And here are the key numbers from that summary. What's interesting is they actually see economic growth picking up next year from 1.7% to 2.3%. They also think unemployment will peak this year and then start to come down a bit. But, and this is the big but, look at inflation. They're forecasting it to still be at 2.4% next year, above their 2% target. This forecast just screams dilemma, doesn't it? Okay, hang on a second. There was another big announcement that day that might sound like they're hitting the gas pedal even harder. The Fed said they're going to start buying Treasury securities again. So what's up with that? Is this just more stimulus? The short answer is no, it's not what you think. These are what the Fed calls reserve management purchases, and it's a purely technical move. It's all about making sure the banking system has enough cash or reserves to operate smoothly day to day. Think of it as managing the plumbing of the financial system, not stepping on the economic gas pedal. And the Fed was really, really clear about this. They said these purchases are, quote, completely separate from monetary policy and are only meant to ensure the system has plenty of reserves. So this is not a repeat of the quantitative easing, or QE, we've seen in the past. It's a different tool for a different job. Okay, so with this rate cut behind us, what happens now? What kind of signals did the Fed send about the future? Well, they sent a few very clear signals. First, policy is not on a preset course. They think they're now well positioned to kind of pause and see how the economy responds. That means any future decisions are going to be made meeting by meeting, based entirely on new data as it comes in. And crucially, a rate hike is definitely not what they're considering for their next move. So if you take away one thing about what's next, it should be this. After 3 straight cuts, the Fed is basically hitting the pause button. They're signaling a wait-and-see approach. They want to watch how these rate cuts work their way through the economy before deciding what to do next. Which, of course, leaves us with a million-dollar question. With a slowing job market on one side and inflation that just won't quit on the other, has the Fed successfully navigated its tightrope? Or have they just stepped out onto an even more precarious part of the wire with the hardest part of the balancing act still to come?